Here. I want to talk to you today about a concept in the financial world, which is called a systematic risk. Now, when I was studying finances, what I blew my mind was the idea that systematic risk exists as a normal everyday concept in the world of financial planners and people who sell stocks and analyze investments and things like that. Because systematic risk says we understand that the system of capitalism and market economics is risky. Period. Inherently. Period. I thought it was a secret. I thought it was a thing that nobody talked about, but it is one of the base understandings of how investing, markets, and capitalism works. It's risky. So, knowing that one of the key just everyday things that people think about when they're talking about money, stocks, investing is this base level of risk, how might that change how you think about your money? In particular, investments that you might have, whether it's through a retirement account or some other account that you've set up for yourself, or just side investments that you have that are money that you're saving on the medium to long term. When we think about risk and investing and systematic risk is the risk that you can't necessarily control for. It's political risk, right? It is, global pandemic risk. It is the risk of, as we're about to see in the coming week, another country deciding to change their oil production and a major and oil prices dropping, right? We're about to see that coming up. It's the risk of just the fact that people kind of use numbers, but also, let's be honest, feelings to assess how much value they think various companies or various market indices are worth. And those feelings and their numbers move with all kinds of things that are everything from global to social to political to ecological. Because, let's be honest, life can be chaotic and anything can happen at any time. Everything that is connected to investing could change at any time. If we look back over history, there have been many, many moments of big change. On average, every 9 to 11 years, there's a drop in perceived value of investments, like we're seeing happen right now. And those drops tend to kind of stay low for 10 to 14 months. After that, you tend to have a period of growth for, on average, 4 years, and then another drop. And if we look back over the last couple cycles of small ups and downs, you can see similar kind of patterns, right? And value of stocks going up, value of things going down. So what can you take away from this, as an investor, as someone who might be looking at their retirement accounts or their investment accounts going, what is happening? Number one is thinking of your money, in particular your investments, kind of like a layer cake. The layer on top is the stuff that you want to potentially use the soonest. Then you have a middle layer, money you might use not soon, but not decades from now. And then money at the bottom might be money you're trying to hold, retirement account type stuff, for decades from now. The further towards the top of the layer cake that your money is, the less systematic risk you want to expose it to, because anything could happen. The further down the layer cake your money is, the more time that you have for systematic risk to not just lose you money, but make you money. So as you're thinking about how you put money together, if you're going to invest it in something that has less stocks and maybe more bonds, because that tends to be less risky. If you're going to put something towards the top of the layer cake that is all bonds, or maybe even literal high yield savings accounts, because those are not risky, although they expose you to inflation risk, which is when you don't earn as much money on your money as the value of inflation, which exposes you to possibly losing value, which you don't want to do, because you want to, if you put $100 aside, be able to buy $100 of pizza or books or whatever with it later. But that's like all a little bit more measured, right? Systematic risk is the thing that causes you to say, what do I think I want to do as I separate out the layer cake of money that I have and think through, can I hold on this money on the bottom layer and come back for it later? Can I think about maybe like having some more mediated investments, a little bit less risky, less exposed to systematic risk in my middle layer? And do I want to like really try to like not have to deal with systematic risk at all on the top layer? Key takeaway, my friends: systematic risk, not a thing just radicals and weirdos and like people who are a little suspicious of capitalism talk about. Everybody talks about it because it is baked into the system. Because it's baked in, you gotta think about it. But there's lots of tools for you to think about it with because everybody else is thinking about it too. So, volatility and risk, it's gonna keep coming at you. It's not a freak occurrence. There's a term for it. You don't need to freak out and cry, although you're totally allowed to have feelings about the value of your money going up and down. It is a part of the cycle. So, a little education on what's happening and what you're seeing. More on this later. Bye.